let's get back to our balance sheet. And we know that we have debt and we have equity, right? And assets, obviously. So what are the debt instruments? How would you get some debt for your company?
Investors?
Yes, investors. I think that's the most common way to get it. In the book is the first financial instrument that they teach you is the bond. I haven't seen any startups that collect bonds. Bonds usually are for companies that are public. A bond offers a coupon, okay? It offers a coupon, which offers an interest rate in paid annually, semestrally, quarterly, I don't know. They pay the coupon, and at the end, they pay all the bonds if they buy it. If you got into the final stage of to the deadline of the bond, they pay all the loan. What else? What other instruments do we have as debt? Loans, no? Loans. What is the first thing that you would need to achieve a loan? You need credit history, no? What if the company has only 1 or 2 years and it doesn't have credit history? The way to get financing for your companies are convertible notes. It's the most used vehicle for startups to get some resources. A convertible note, it's debt that could be transformed into equity. That's why, David, you don't enter into a company and convert and buy equity. The only vehicle in startups to raise money is convertible notes. What they do is, by the end of 5 years, you have the option to convert this debt instead of paying you, like I told you, in a bond. It's very similar to a bond. It's like, I pay you a certain interest on a monthly basis if you want. And at the end, you decide if I return you that loan that you gave me, or convert that loan to equity. At what price? You don't know the price. It will depend. But what you can offer, it's a discount of the price that we packed at that 5 years after. I will give you a discount. So I'm telling you since the beginning how much you will earn. If the price is $10, you will buy it for $7. So at the end, you have a return, an immediate return of 30%. Agree? How do you establish this $10? The most common way is that the next financing round. Somebody wants to buy you, you need more money and you want to raise more resources. That's a financing round. I have to explain you. Yeah, the equity. When you establish a company, you have to settle an equity. Like here in Mexico, it's 50,000 pesos, which is like $2,500. Okay, and this amount represents certain level of stocks. It's more work for you. Established since the beginning, 10 million stocks. This is very common in the United States to establish at the beginning 10 million stocks, because if you price them at $1 per stock, then you have the capability of raising 10 million USD dollars, right? If you do it the Mexican way, like at the beginning, the notario, public servitor, they tell you to issue only 50 stocks. I've been in that situation. Don't do it, guys. It's just more work for you. But at the end, the important part in here is that you have to register those things in there is a federal public record. When you create a company, there's a public record of all the companies that tells you how many stocks do they have and who has them. Who is the owner of those 10 million? Imagine that these 10 millions are mine from Enrique. So when I buy, when somebody wants to finance me and convert these notes into stock, who am I gonna buy them to? To Enrique or to the company? These 10 million stocks, guys, are called treasury stocks. Treasury stocks. The company owes that, owns those 10 millions. When you establish the shareholder proportion, you sell them that proportion. If you are pricing them at $1 and you want them to have like 51% because Enrique has control and David has 99%, you price them, you can potentially give them, I don't know, 10 million, 2 million to Enrique and 1,999,099 to David. But you leave more shares in your treasury, in your treasury shares. Okay. So when you have a new guy that wants to enter, they buy from the company those shares. They don't buy it to Enrique and they don't buy it to David. As I told you, if it's equity, you have to register into a notary. And it's expensive and you have to do a lot of work in a lot of job matters. So in a convertible note, it's just a commercial contract between you and me, where if it's like a loan, give me some money in exchange for some interest. And at the end of 5 years, when we establish a price and you decide to convert those into equity, if you want, then we go to the notary. Guys, what do you think that determines the interest rate of a bond or any debt?
Risk.
The risk. Excellent. Have you seen that bonds are ranked? And what does it means this? And what does it means this? And what does it means this? Can anybody explain me?
It has low risk. Then as the letters go down, they are more risky.
You have several companies that do the ratings like Fitch, Poor's, Standard & Poor's. So you have multiple ratings that are assessed per each company, but at the end, the logic is the same. Like if you go under this, it means that you have more risk of default. You also have stocks, as common stock and preferred stocks. You issue stocks when you know how to price them. And usually that happens when you go public, when you do an IPO. Basically, I just explained you how you finance your companies, how you finance your growth.